Nearly 1 in 5 sellers is dropping their price, the highest rate since October 2019. Fewer people search for homes for sale on Google, down 13% from a year earlier. Mortgage payments are higher than rent in 45 of the 50 largest US metros, up from 22 in 2019. This is something I can attest to as an investor. Ballooning mortgage costs caused by a combination of price and interest rate SpaceXing through the stratosphere have made mortgages virtually unaffordable. At levels similar to 2007, things aren't looking good, y'all. And again, more talk of recession this week. What does this mean for you and the housing market? Will we see a change in direction for prices in the currently hot markets? Will demand drop to a point that we overshoot equilibrium and end up in a 2008-like crash? What's up, everybody? I'm Sean McMurray, co-host of BPM REIA Online, and this is Mr. $250 million in real estate transactions, my mentor, my good friend, and president of BPM REIA, Anish Dave.
Hey, thanks for visiting us again. My name's Anish, CEO of BPM REIA.
Much is being made about recent data coming from Zillow and Redfin. We have 20% of home sellers dropping their price during the 4-week period ending May 22nd. Mortgage purchase applications were at a level on par with June 2020. ShowingTime.com, which tracks the year-over-year impact of COVID-19 on real estate showings across North America and in individual states and provinces, is reporting showings down quicker than the Island Boys' 15 nanoseconds of fame.
Yay!
Which isn't exactly fair. Well, it is about the Island Boys, but to be fair, according to the graph, showings dropped during the week of July 4th, but overall, it is significantly down since February. All that to say this, it is not looking good for the end buyer. As investors and in the real estate ecosystem, the end customer or end buyer fuels the system. Certainly, our direct customers tend to be other investors, but their customers, for the most part, are the retail buyers. In theory, if that customer is not buying homes, then that means our direct customers aren't offloading homes, which means they will slow their purchases or stop purchasing altogether, which then means we aren't selling homes. No! I know that's probably an oversimplistic explanation from a novice investor, not newbie. I caught some slack for that in my last video. I misspoke. I've been in the game for about 7 years now, although where Anish has dealt with millions of dollars of real estate transactions, my unit of measurement is in the thousands. No shame in my game. I'm a forever student of the craft. Anyways, as an investor, Anish, are you worried that things may slow down?
Yeah, you know what? I'm a little bit, I wouldn't say worried, but cautious is what I'm going to say. Meaning, I agree with you, Sean. You know, the end buyer, if they're not buying, it might be some trouble. But if you're actually an investor holding onto properties, this is a great time, right? Because what we're seeing is rents are still going up. There's still a shortage of housing. So your return on cash or ROI is still going to be good. Especially here in South Florida, appreciation still going up. We are seeing some big companies moving in from hedge funds, the crypto companies. And yeah, I know the crypto's down a little bit, but they are still moving their headquarters and down here, and they're bringing a lot of high-level executives too. So I think it's still going to be some good room to make some good money.
That's a good point. Although I saw a position online, and for the life of me, I can't remember the source of it, but essentially, this individual was predicting that the upcoming collapse will be far worse than 2008. His or her reasoning was that back in 2005, 2007, home prices increased due to individuals and families buying more house than they could afford. However, they purchased these homes to live in. As of today, the main buyer of homes has been investors, hedge funds, or corporations who are not planning to live in them. And this is the part that stuck with me because I ran into this issue a few months ago as I tried to buy our first rental property retail. Essentially, the prices of homes was not conducive to cash flowing at the current market rates. In fact, I was losing money substantially with some of the deals I looked at. So for the investors who overpaid to the seller, they're heavily leveraged. They went on to explain that market pricing is a feedback loop. Excessive investor purchases create a shortage, which drives up prices further. This will ultimately collapse. How do you feel about that? Is there any?
Yeah, so it's kind of funny what's been happening, in these last year or two. It's a lot of FOMO, right? Fear of missing out. It's like, hey, I want to get into crypto or other things out there because it's popular. So people were overpaying, right? Meaning they're not looking at cash flow. You actually made the right decision by passing on deals. It's got to be about cash flow or value add. Meaning, what are you going to do to the property for the highest and best use? Are you going to add another bedroom? Are you maybe Airbnb short term? So you have to have multiple exit strategies, and you cannot be over leveraged, meaning you cannot borrow more money than versus the rent or the income you're taking. So as long as you start learning these skills, it is a great time because, especially like you were talking about, those novice investors, they're going to step out, right? They're going to lose their butt. And, it's going to be more room for the guys that really know what they're doing.
I feel like a broken record here.
The one that skip, whoop you when I wanna.
I understand fully the conditions that led to the 2008 crash, but for our viewers out there that may not fully understand or may still have doubts, do you feel demand will drop to a point that we overshoot equilibrium and end up in a 2008-like crash?
Yeah, so I don't think it's going to be, again, like a 2008 crash. The big hedge funds, there's a lot of money out there, and I'm talking institutional money, which really means hedge funds, and they are really moving into the space. Hedge funds started really getting into the single family realm right after the crash. They need to park their money somewhere. So there is an abundant amount of money. So that's why we're even seeing some of the challenges with inflation. I mean, the US government, the feds, we're trying to battle this inflation stuff because people are spending too much. So they actually want to slow down the economy.
One more question, which is in relation to a question asked to Redfin economists. Yeah, a question of a question of a question. Yeah, This one stuck with me because you've stated this on a number of occasions, and I was just like, yeah, my guy knows what he's talking about. The question was, what's your advice for sellers who regret not selling sooner because they could have earned more? And that's not my question. You stated before, Nish, that you prepared us for this exact scenario, i.e. homeowners would begin to get what is called seller's remorse in a sense, and that they may rush to sell their homes in order to lock in the elevated home prices before they dropped. This essentially might cause the opposite to happen as homes flood the market and there is more competition. Is this something that you or our organization, BPM REIA, is seeing?
Yeah, we're starting to see that a little bit. The price drops are happening. The one fear is people are saying, hey, I could have got $400,000 5 months ago, and now it's only worth maybe $370,000, or there's less showings. So they're saying, look, I want to get out. I want to get my money already, which will add more inventory, or now it's in our game, right? Especially if you're paying cash. And we're not worried about using leverage because we've raised our own money. So you could be a lot more selective. And now I'm even seeing where sellers are surprisingly paying for closing costs too, if you're good at negotiating.
If you can't tell, we are bullish on real estate. Good or bad, I'm just confident in our ability to get creative with any scenario and be able to figure out a way to turn a profit. In fact, I was too young for the collapse and rise of the dot-com bubble. I wasn't positioned knowledge-wise or financially for the crash and rise of 2008 housing crash. But I've made very clear this is my 2008. I've prepared knowledge-wise and I have prepared financially. I certainly hope that people do not lose their homes or that anything bad happens. I'm not wishing that at all. But if the market does take a turn downward and I can help a homeowner save their credit and or move on with their lives much quicker, then I'm positioned to do so. If nothing happens, I'm still buying and selling real estate. Have you all prepared? Comment below. Don't forget to like and share the video and hook a brother up by tapping that subscribe button. And last words, Anish.
Yeah, so Sean, you know what? I know I lived through 2008 and I got wiped out. And what I always thought was everyone got wiped out, but some of these old-time investors, older than me, made millions of dollars. So what I feel right now, if there is a little correction of what's going to happen, we're going to look back, 5 years in the future and say, wow, 2022, those were the good old days. We made a lot of money in helping out people, and we made it a win-win.
I'm Sean McMurray.
I'm Anish Dave.
And this is BPM
REIA.
And we're out.